Welcome to our second quarter update for the retail properties. Andrew and I are excited to go through what we are seeing in the market and then touch base a little bit on our operations and transactions that we have coming up here.
Right, so it's another pivot for us because retail is changing right underneath us.
And it's happening as we're watching.
Yes, as we're watching, and we're in our little pivot right now, trying to figure out what's next. And there is still a conversation about buy value, and so we're always still looking at short leases, maybe long leases. We're looking at good brands, good operators. It is the same business plan. It's just how do we pivot and buy properties with that business plan now, because it's harder.
Definitely. The past 18 months, we've seen this shift where as rates were coming up, cap rates have not adjusted. So cap rates maintained, and essentially what that did was really remove the spread that was available between debt and cap rates. So your overall debt cost is most of the times higher than the cap rate.
Remember the good old days when we bought a deal at a 7.5 cap and we got 3.5% debt?
Yeah, that's not there anymore.
It was the good old days.
The cap rates stayed the same, but the interest rates are a lot higher now.
Cap rates moved maybe a point, so they moved 100 basis points. Interest rates moved 400 basis points.
Yeah.
So when we're 70 years old, we're going to sit. Remember those good old days with 3.5% interest?
Yeah. So the market as a whole has been challenging to buy stuff in. Really, the only opportunities that we saw in the market were buying Dollar General. We saw cap rates in the retail world spike a little bit, where we could get into high eights while their stocks recovered. Cap rates, we're looking at cap rates and seeing them, oddly enough, right now in this market going back down.
Yeah, and it's back to the whole thing when you buy when everyone's selling and you sell when everyone's buying.
So right now, retail, cap rates are very stable. Debt is still fairly expensive, so there's not a whole lot of spread that's out in the market right now. All right.
Right. So because right now, we could buy Dollar Generals at an 8.5 cap pretty easy, but then the debt on that 8.5 cap Dollar General is going to be 7.5, and the 100-point spread is
not enough to pay principal.
It's not enough to pay. You could probably pay your mortgage, but as far as like profit in your pocket, there's nothing left over at the end of the month for you.
No.
So you're doing a good job paying the bank. The bank likes it.
So things that have been working well for us, all of our assets we have are paying. Our tenants are in good shape, and they've all been performing well.
And one thing we can say about the retail portfolio is 100% occupied. So it's a victory. And it's been 100% occupied for a long time. So that's good news.
Yeah. Another thing we're looking at right now is we have one tenant who now they have a 3-year lease left, so they still have a lot of time.
Right.
One of our Applebee's locations, and we bought this one in a pool. Right, it was run by corporate, and then not run by corporate.
Right. So we thought we were buying. Well, we did buy an Applebee's corporate location that was run by the corporate franchise, by not the franchisee, but the franchisor. And you think, as far as the guarantee, the guarantee doesn't get better than that. And then eventually they sold off this portfolio to an operator, and the operator, I can make it whatever story I want, but the bottom line is we don't think the operator's going to renew their lease in 3 years, and so we are very proactive. We're being very proactive about looking at all these lease renewals, because to replace a retail tenant, it's not something you do in a few months, and there's also a lot of strategy behind it, like what brand goes there. Do you scrape the location and build a new building? Do you try to put a tenant in the existing building and retrofit a new tenant in there? Do you try to talk to a neighbor to say, hey, Mr. or Mrs. Neighbor, do you want to expand into this location? And so with, in fact, this Sumter location, there's a hotel right behind it. And so there's a hotel operator who has a piece of land in front of his hotel and behind our Applebee's. And so, we're exploring all the options that exist right now and being proactive about it.
Yeah. We've got 3 years. You have a good amount of time. Yeah. We still want to, get started.
Yes, and we'll have some, and we're not, the distributions aren't being paid for this because we're expecting to maybe either have to re-tenant it, and if we re-tenant it, it'll cost a little bit of money on TI, but the end result should be the end result I would like to see is like a major branded restaurant going in there with a 15-year lease and with very good credit, and so those deals do sell really well, and it'll be a lot of work, but but we'll make money.
Exactly. So a lot of, and we have we have other deals where leases are coming up for renewal. So we're typically looking at how can we get these deals where we have a short-term lease, sign the renewal, and that's where we see that bump in value. So we have 3 deals where leases are coming up in the next 12 months that we'll look to renew, and we have one that we just did a renewal with the Dollar General.
Right. Dollar
Took a 10% bump.
Right. Severe
Lease.
New 5-year lease, 10% rent bump. Doesn't get better than that. We did. We had to pay a little bit to do that. We got the parking lot a little bit nicer, and so we got the 10% rent bump, which means that when we sell it, we're going to sell it on a cap rate based on the 10% increase in rent. So that's money right there for us.
I mean, in the past, we re-tenanted our Edgewood property too. So that was that tenant blew out of that location. We re-tenanted it, did the retrofit, and then ended up selling it, and we did really well. Yeah. So we've done both as we go into these renewals, where we either renew with the current tenant or we re-tenant and then sell the asset. That's really the biggest operational one that we're going through now. The others, we're fairly confident that we will have renewals and some increases there. That's really that point in time in the investment cycle that we look at: do we take it out to the market, or do we refinance it and get a new loan? Tied to longer term.
You just have to remember too that everything we buy, it's a recognizable brand. We're buying major branded, a lot of times publicly traded brands in our business, and so it's there's a connection that many of us have, like the Zaxby's that we own. We own Zaxby's, DQ, Applebee's. These are all very recognizable brands, and with that recognition, there's also some industry credibility. There's brand value, and a lot of times you're following the value of the brand. Like Zaxby's, when we first started buying Zaxby's, it was pre-Goldman Sachs. Remember that?
Yep.
And then all of a sudden, Goldman Sachs said, "Wow, this is a nice brand. I want to buy it." And so then, Goldman Sachs is doing their thing with Zaxby's right now, and we have 3 of them, right? 3, and I think those are some of our most valuable assets. And we have a great operator. And if we could only do that 10 more times, it would be amazing.
That would be fantastic.
Yes.
So on the speed of that,
honestly, the Vortex is the same thing. Great operator, great brand. It is a local brand, and it's the same story.
Yep.
So the more we do that, I think the better we're going to be.
They perform.
And they perform. Yeah. Right. Yeah.
So we look at the transaction front. We're going into a sale or a transaction typically because we did sign that lease renewal, or we have a really good asset that we get an off-market for. So we have both of those happening right now. We have the DG where we had a lease renewal and said, okay, let's take this to market and see what we can get, see what kind of gains we can realize there. And then we had an off-market offer on our DQ.
Our DQ and Marietta, and both great brands, and both DQ is located on Powder Spring Street, which is it doesn't get better than that. The most valuable time to sell a property is going to be the day after you receive that lease renewal.
Yeah. So and most of our assets too, we're sitting in this $1 to $3 million price range thing. So there's a lot of liquidity. There's a lot of purchasers out there that are buying this.
Right. The customer base for that $1 to $3 million deal is this big, whereas like for a $5 million deal,
it gets smaller.
Just small. Every time you go up in price point, like a $10 million deal is even smaller, sort of thing. So, it's and I didn't even think about that when I first started doing this, but it's a lot easier to sell $1 million deal than a $3 million deal. It's a lot easier to sell a $3 million deal than a $5 million deal, and so on and so forth.
So all of our deals have been performing well on the retail front. We're excited about where they're at. Buying has been a little dicey.
We just did DG Eaton. We closed in that the same order. In that, I will say, I love that deal. And
that's an excellent location, excellent product that's there.
Yeah, and it's a unicorn. We call it a unicorn. So we found another unicorn.
Yeah, they're hard right now, though. It's like tricky to find stuff up there.
Yeah, especially DG markets. DG markets are a very small subset of the DG population, but it's also. All of the feedback given about Dollar General is that it's not a real grocery store. You're charging low-income people a lot of money for junk. But then DG Market came out, and essentially it's solving that problem. So DG Market is the way Dollar General is actually improving their brand, quite frankly, and they're becoming the main grocery store the valuable grocery store in the area versus just the grocery store of last resort.
Yeah. I mean, that's a good one. They're hard to find.
They are
Very hard to find stuff that fits right now in our model that we're looking to do. However, we're out there. We're going to try and find as many as we can.
Yeah, I mean, remember, everything we do is opportunistic. Everything we do is there's some opportunity. We're not buying market deals. We don't buy a market deal that sells at a, a typical price that an investor might pay. We're looking for, if you have a pyramid of deals, we're picking deals off the top of the pyramid that are priced the best. We're not picking deals in the middle or the bottom. And, probably our acquisition people get a little,
slows down on volume, that's for sure. But
it's a needle in a haystack, and I
trying to
think
get the best one.
we do a good job at that. I mean, when we're finding that needle in a haystack, we're doing our job. So that's what I view as my job.
From an investor standpoint, our distributions, they go out on the 20th of each quarter. So those are coming out right now. You can look in your investor portal. That's where you see all of the deal by deal specific information in your investor reports. We're also going to do our live Q&A that we do every quarter. So please check out that invite. If you can attend that, that would be fantastic. We can go through the specifics of every deal there. And then lastly, we have our goal day. If you haven't been to one of our goal days, it's a great event, really a day of goal setting for now, what's going to happen for the next quarter looking forward. So that is on July 24th, if you can make it for that too.
And we also have a great speaker coming too for Gold Day. So
Eric, we're speaking this quarter. It's going to be very interesting.
Yeah, I'm looking forward to it.
You're cool. Thanks for watching, everyone.